Hello friends, basically in the past 1 year, Mr. Powell here has been very, with another 10 varies, busy. And what has he been busy doing? He's been busy making the money printer go brrr, right? And in the same time, you can see that from the bottom of the March COVID crash, we have gained 93% on the stock market. So why is the Federal Reserve now saying that they are going to stop buying so many bonds and they are going to raise rates after that, right? Why do they want to take away our free money? So all this and more in this video. So quickly, let's jump into it. First of all, as always, the disclaimer. So no one sue me. Read this disclaimer. Make your own decisions after you make your own research, right? So without further ado, let's jump into it, right? So Federal Reserve announces taper. So what is tapering? Tapering is basically buying less bonds and stopping their purchase of bonds, right? So Federal Reserve holds interest rates steady, says tapering of bond buying coming soon. So officials indicated that they expect to begin reducing monthly asset purchases soon, but did not say when. In my opinion, they don't say when because they don't want to get scrutinized if the data changes. Let's say they come in like with weaker employment data or high unemployment data. So they don't want to be scrutinized when they want to make another move, right? Basically, basically if they don't want to increase the rates or don't want to slow down the bond buying, they don't want to get scrutinized. So it lets them be more flexible. So number two, economic projections pointed to slower overall growth this year, but higher inflation than previously projected. So we all know what that's called, right? That's called stagflation. So stagflation is basically when inflation is going up, but growth is going down. While no decisions were made, participants generally viewed that so long as, when they say participants, they mean the Federal Reserve board members. So long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely appropriate. I want to highlight this last point, middle of next year. And previously when we have tapers, they basically take 1 year, right? And you can see today is the 28th of September. September, right? So basically today is the 28th of September, and basically they haven't announced the taper yet, right? So we expect them to start tapering in November. So if they start tapering in November, they only have about 7 months, right, till the middle of next year. And this is very surprising because normally when they taper, they take about a year to get rid of all the bond purchases. So why are they doing it in such a hurry? So that goes to my next point, right? That transitions to my next point. So the ongoing energy crisis. So we can see that a worsening energy crisis is the next big risk for China, right? After the Evergrande situation, a shortage of electricity poses a second major economic challenge. Basically, they can't get enough coal and natural gas. And this is similar to those that hit Europe behind the power crunch. And I'm going to get right into it, right? Like, there's 3 examples here. One is from the UK. So millions of households could face a second record jump in energy bills next spring. So 139 pound increase due next month. And in April, another 178 and 294 pounds increase to the typical price of default dual fuel energy deal. So yeah, those are two countries that already have energy problems. So let's look at the third country, right? And this is Germany. Contract for next year surpasses previous high set in 2008. European power and carbon prices surged to a record high, driven by the soaring cost of other energy commodities. And you can see that in the past year, from 2020, it has jumped from 30 something here to 90. So that's about doubling. So this is higher than the 2008 record that they held, right? So yeah, we can see that all these energy prices are going incredibly high because of, well, the main reason is because there's too much liquidity, there's too much money, and there's a huge demand for electricity while there's supply chain issues, bottlenecks. The whole year, maybe people have not been producing due to coronavirus. They can't produce all their fuel, LNG, they can't produce coal and all those other raw materials. So what's next? Are we going to go through another 1970s situation all over again? And if, for those of you that don't know what happened in the 1970s, because I wasn't even born yet, so basically in the 1970s, there was a decade of inflation, one whole decade, right? While it may be surprising to some that the average inflation for the whole decade as a whole was an average of 6.8%, this rate is double the long run historical average and triple the rate of the previous 2 decades. So basically, you have 6.8% inflation for one whole decade. And imagine if on the year 1970s, you bought a loaf of bread for $1. Basically, in the year 1980, you'll buy the same loaf of bread for $1.68, right? That's 68% inflation in 10 years. So that's crazy amount of inflation. Let's just imagine that bread example, right? Can you imagine how many people will need to eat less bread because they can't afford it anymore? So let me just show you the graph. And basically this is stagflation, right? You can see here that the growth in blue has went down. The inflation in red has went up. This is due to the Arab oil embargo, and unemployment has also steadily went up. So all three of these things are the Federal Reserve's basically their mandates. And basically you can see that in this period they failed horribly, right? So are we doomed to repeat this situation all over again? So in my opinion, I don't believe that it will be a repeat of the 1970s. So what is the reasoning? I think there's a very simple reasoning, right? And everyone's talking about black swan events or black swan theory. Is a metaphor that describes an event that comes as a surprise, has a major effect, and is often inappropriately rationalized after the fact with the benefit of hindsight. For example, the dot-com bubble or 2008, we can easily say that, oh, you can see there's a mania and all going on. But at that time, it's very, very hard to see that the raising in interest rates the lowering in interest rates in the year 2000 will lead to the real estate bubble in 2008. So I just want to highlight that as a surprise, these three words are very important. So why do I believe that we won't repeat the 1970s? It's because this has to come as a surprise. And if we have already been through it, I don't think we will be so foolish to fall into the same pitfalls and repeat the exact same mistakes. I think the those next mistakes, like Evergrande will not be the Lehman of China, because we have already been through that. They have used Lehman as a case study to fix into their models and how they're going to deal with it, right? So I think it's very unlikely that they are going to basically repeat the exact same event. And so do I think that we can have high inflation for a couple of years, maybe 2-3 years, maybe 4 years, or at the longest, I would think it's only 5 years? And the answer is yes, because we won't repeat the whole same exact 10 years, right? Definitely not, because a lot of people will cause a lot of suffering. A lot of people will be unemployed. It will cause a lot of social unrest. And basically, if we already know what's going to happen, we can take preventative measures, right? And that ties back into the the middle of the year taper. So why are they trying to taper so fast? And I think the reason is very likely that they are trying to taper so fast because they are seeing the makings of the past events that are coming. Like basically Evergrande is collapsing. There's very high inflation for the past year already, right? About 5.4% inflation for the past maybe 5 months already. So they don't want to repeat the exact same thing. And since that they have the case study of the 1970s, now they're going to take the case study and apply it, right? I don't think they're so stupid to see the same thing happening and let's just sit there and wait for our economy to crash. So basically, that is why I don't believe there'll be a repeat of the 1970s. So my conclusion is that the Federal Reserve is finally tapering. This has been delayed very long, right? They've been trying to delay it as long as possible, free money as long as possible because they don't want to crash the stock market. They don't want people to get unemployed and all that. They want people to borrow money, easy credit, fuel the real estate bubble, fuel the stock bubbles. Yeah, and they don't want to lower the interest rate. But now they almost have to, right? So although they do not specifically mention the reasons, I think it's pretty obvious that their hand is being forced right now. When they look at the energy crisis, they look at the inflation rates. So their hand is being forced by the reasons mentioned above. However, I do not believe that this will be a repeat of 1970s and 1980s inflation due to the fact that we have already gone through it, as I explained. So for all the people that are like Michael Burry, they're saying it's going to be hyperinflation. This I don't believe in, but I do believe we can have very high inflation for maybe 5%, maybe 6-7% for the next maybe 3 to 4 years or maybe even 5 years, right? So that's my conclusion. Hope you guys enjoyed the video. That's all I have to share for today. Thank you very much for watching till the very end of the video. If you did enjoy the video, smash up the thumbs up button, smash the subscribe button, and press on the bell notification and press all. And do leave me a constructive comment, right? Any constructive criticism or any positive feedback will be much appreciated. And with that being said, thank you very much again for watching till the very end of the video. Have a fantastic day ahead and peace out.